Good morning. It's Monday the 10th of August, mid-August. It's a little quiet out there, but there are things you still need to know. The Strait of Hormuz is still effectively closed. Oil is pretty flat this morning. After enjoying last week's big squeeze higher, stocks drifting into Monday. And US CPI definitely dominating the agenda this week. That after Friday's payroll shocker, Tom.
OK, there's the equity market drift that you were talking about then, Guy Johnson. European futures currently flat after decent gains, of course, last week. Global equity market still near record highs. Brent then currently down 0.2%. We came in this morning and oil prices were higher. That has adjusted, currently at 83.42. On the impasse, of course, around Hormuz, we continue to monitor for details on that. The Japanese currency under a bit of pressure, down 0.4. The dollar is gaining in the session, 158 right now, despite the fact that the minutes from the BOJ suggested a bit of a hawkish tilt coming through from the Bank of Japan. We continue, of course, to monitor that currency. The countdown to the opening trade starts right now.
Morning. How you doing? Feels like a mid-August Monday, doesn't it? Yes, we're watching what is happening in the Gulf quite carefully. Yes, we've got some CPI data coming up this week, but it feels a little slower than maybe it did last week. Last week was a big week. Equity markets had a massive few sessions. We'll get to that in just a moment. Let's start off, though, talking about what is happening in the Gulf, or not happening in the Gulf. It is still effectively closed. The Iranians made a whole load of demands over the weekend. Trump said last week, back end of last week, he thought we were getting close to a deal. Doesn't feel like we are this Monday, does it, Skylar?
I mean, not at all. I think I really question why the oil price isn't higher, right? We had that shot, kind of gradual rise throughout July. And the things that really scared us in July in terms of the Strait of Hormuz being closed, threats to Saudi supply, those are still very much in action in terms of we did get some Houthi attacks on a Saudi facility over the weekend.
Yeah.
So, why aren't we higher?
It's August. Honestly, I just do. I seriously wonder about that.
But this question has remained. Why are we not seeing the inflationary impacts as we look ahead to CPI out of the US, and we'll unpack that for you shortly. Why are we not seeing higher prices when it comes to soft commodities? Some examples are there. Why are we not seeing higher prices in terms of additional goods that are being shipped through the Strait or not being shipped through the Strait? The inflationary impact, we're expecting slightly softer inflation when it comes to that print. A tick up, but nonetheless 0.1% versus a contraction in June. We're still not seeing real evidence that we're seeing strong inflationary inputs as a result of what is happening in the Strait. The physical infrastructure is still there in terms of the attacks. $83 a barrel. The president talking again to Axios, saying that now he's going to low-key it with Iran. He's going to wait for the inflationary pressures, the economic damage to take its toll on Iran. That seems to be now the calculus. A week ago, of course, he was threatening severe attacks on Iran.
The market doesn't know what to do with all of this, which is probably why we're doing absolutely nothing at the moment. Are we going to reopen it? Are we not going to reopen it? Are we going to see prices going higher? Are we going to see them going lower? I keep watching the product market, which still remains quite high. US gasoline prices are still pretty elevated, which has got to be a pretty big metric for Trump. November's coming. The summer's going to be over soon, and we're going to be into that run into the midterms. And if oil prices stay high, that's not going to be a good thing for him.
And yet the stock markets are near record highs. So maybe he can take some solace from that. What does that mean for the retail sales later this week out of the US with equity markets where they are? The K-shaped economy is still there, of course. So you saw that return in terms of the AI trade, that catch-up in Asia. We saw that in the session. We saw the Nikkei responding, of course, on the back of that. Gains the last time I checked around 2% for the Nikkei. Maybe that is a catch-up
story. Trade,
that's Friday's trade because the jobs numbers came in weaker, and you saw, of course, a drop in yields and a bounce in terms of US stocks. So the catch-up is there. European futures currently essentially flat.
We weren't here last week. Skylar was. Does that feel like a squeeze?
Yeah, I mean, I think the market wasn't expecting that low a number. And the big thing was the revisions, right? You had 3 months that, were pretty downward, really revised. I think, though, particularly for European equities, I've been really surprised by the fact that the earnings momentum, the earnings growth has been so strong, despite the fact that you had higher energy prices, despite the fact that you had higher yields throughout that quarter. There was a lot of resilience there that I just wasn't expecting. And so I think the European earnings story, yes, they're still cheaper than the U.S., but also there's a fundamental story there in terms of what the backdrop is for these companies from a profitability perspective.
17% earnings growth. You got the stock 600 at 75% of stocks in the stock 600 currently above their 200-day moving average. We've got a chart that shows that. So this is broadening out as well.
The anti-AI trade.
Well, there was also some reporting, some analysis over the weekend about not just those companies in Europe that provide some of the components around AI, but the AI adopters as well, flagging companies like Standard Chartered, flagging companies like E.ON in the energy space that are adopting aggressively, and the payoff is coming through now.
Is it?
I mean, I think last week as well, though, there was more optimism around the AI trade and tech more broadly, because the week prior we had this big positioning washout. You saw, leveraged AUM and ETFs in Korea that had come down quite a lot, rise again last week. And so maybe people are going, we've had the clear, we've had some kind of big things unwind.
You talk to the banks, the primes had pulled a lot of leverage back. And it felt like maybe you cleared through that process, and then suddenly you were able to maybe put a bit more leverage on, get a little longer. It felt like some of that last week, that we'd kind of gone through that positioning story and then kind of had the option of going back in. Anyway, CPI, what do we think?
Yeah, I mean, it's a very important print, definitely. It's a binary outcome in that we know that the Fed has put a lot more focus on inflation than jobs. The last print was very soft, and so if we get a second soft print, that's a trend then, where you start to question whether or not hikes are really needed. I do also, though, on the other side, think expectations are for it to decline. You've had a soft print, so maybe, that's already baked in terms of pricing. And there might be quite a high bar to price out hikes entirely. And post-NFP, we only have one hike price this year. And that high bar potentially exists because you have a credibility issue at the Fed, and that inflation's been above target for so long. And there's no way this print comes in line with target. It's at 3.7%.
That was going to be my question, was how weak does the inflation print have to be to put aside the credibility concerns, to allow the Fed to be on hold without a question mark over their credibility? That also came up, obviously, in the last meeting and the divisions that we saw at the Fed.
Okay. We will carry on these discussions. We've got some great guests lined up throughout the show. We'll talk about what's happening with the oil story and these market story. By the way, Skylar, thankfully, is going to be here all week because Tom and I have been on holiday. Anna's on holiday. You're basically the anchor around which this show is going to be built this week because you know what's going on, which is fantastic. So it's good you're here. Anyway, who else have we got coming up? Amrita Sen, Energy Aspects founder and Market Intelligence Director, is going to be here shortly. Dan Scott will be joining us out of Zurich from Vontobel. We'll get his take. Tanya Roche is going to be joining us from 12 Capital, head of Cat Bond Portfolio Management at 12 Capital. So that's an interesting conversation because what we're going to be talking about there is the wildfire story and how Europe actually isn't set up from a financial point of view to manage the risk around that. Yeah,
the catastrophe bond markets, cat bond markets in Europe, are they modelled correctly? Are they pricing it in? Are they actually covering much of this?
Are they mature enough?
And are they mature enough? And what do regulators, what does the industry need to do to start to address these risks and how to finance around those risks? Coming up, closing the gap, China is looking to tap its $28 trillion capital markets to catch up with the US in the AI race. We're going to have more on that push. Plus, Berkshire Hathaway shareholders get their biggest quarterly payout since 2021. We're going to break down the company's latest earnings. Up next, though, we're going to speak and be joined by Peter Shafrick, global macro strategist at RBC Capital Markets. He has a view on these central banks. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
At present, we are not engaged in any negotiations with the United States. As long as the American violation of the Memorandum of Understanding continues and the US does not make amends for its violations, there is no possibility of resuming negotiations.
Iranian Foreign Minister Abbas Araghchi speaking there. Let's stay on that story then, because Iran has rejected talks with the US and a deal to reopen the Strait of Hormuz remains elusive. Araghchi did say that Iran was, quote, very close to a pact with Oman to establish a shipping route through the waterway. While Tehran ruled out direct talks with Washington, President Trump says the US is, quote, semi-negotiating and can wait for Iran's economic suffering to soften its stance. For more, let's bring in Bloomberg's Abir Abu Omar in Dubai. Abir, get us up to date on what we're hearing from the Iranian side, the Omanis and the US at this point.
Good
Good morning, Tom. Well, I mean, I wish I could tell you something other than the talks are still ongoing between Oman and Iran at this time. We had reported that last week. The two countries were discussing ways or a mechanism to restart shipping through the Strait of Hormuz temporarily to open up some kind of pathway for those vessels that are stuck, for those oil barrels that are stuck to start making their way through the globe. But for now and until today, what we hear from the Iranian side is that those talks are still ongoing. They are in the final stages, and then there are some delays, of course, in getting the formalized final draft. Now, what we've reported last week, Tom, was that Iran and Oman are discussing this mechanism to get the ships moving. One part or one caveat in that draft that was reported by Iranian state media is that Iran and Oman will not allow Israel or U.S.-flagged ships from making their way through the Strait of Hormuz. Now, that is not a massive deal just because we've reported that historically the number of U.S. and Israel flagged ships that would make their way through the Strait of Hormuz is very minimal. But then the other caveat that is quite important is that they both say that they will not allow, or that they will have to start charging countries that they deem hostile money to go through the Strait of Hormuz. A lot of traders were considering that as signs of them charging countries from the GCC money to start making their way through the Strait of Hormuz. Of course, none of that is formalized. At the time being, we're still waiting for the final draft by Iran and Oman to make its way to us, and then we'll be able to determine just what exactly is that mechanism and what will ensue in the Strait of Hormuz, where traffic, Tom, is still very much either paralyzed or hardly moving, with the same trend of ships moving with their lights turned off and still going through with the risk of being attacked. The latest example of that, of course, was the Adnoc flagged ship over the weekend that was attacked in the Strait of Hormuz, with one fatality and over a dozen injuries there.
A bit. Let's just talk about what we also saw on the other coast effectively this weekend. Saudi Aramco's Jazan refinery hit once again. Houthis, which are aligned to Iran, say they hit that. What do we know about that attack and how much damage was caused?
Yeah, and that is the other risk, Guy, right? So the Houthis based in Yemen have claimed that they hit this Aramco plant based in Jizan. That would be the second time, at least, during the duration of a month that plant would have been attacked, and the Houthis claiming that they have targeted it. Now, what we know from Aramco is that a fire was noted there. They did not confirm that it was the Houthis. It was extinguished pretty quickly, and no injuries were reported there. But then when you look at the broader picture, it's not just the threat of the Houthis attacking Aramco facilities, which is already a big enough threat, but also attacking ships in the Red Sea. As you know, Saudi Arabia had resorted to the Red Sea, to Bab el-Mandab, another crucial waterway, throughout the course of this war to get its shipments across. So now that waterway is also prone to those threats by the Houthis. So that brings up the parameters of this war, or this widens the parameters of this war even further, let alone the fact that we also have reported on militia based in Iraq attacking Saudi Arabia. So all in all, really, if you compare the situation now versus how the war had started, the parameters have been widened. Although for the time being, the situation in the Middle East is a little bit of is not escalating the way we had seen it about a month or so ago. But that risk of another escalation is still very much on the horizon. And that is why you're seeing Brent crude prices around $83, $84 on the barrel. So not yet at $100 or so, but we're just bracing ourselves for further escalation in the region as we await that interim agreement on the Strait of Hormuz.
Abir, great stuff. Thank you very much indeed for the update. Abir Abu Omar joining us out of Dubai on what is happening in the Gulf, the region more widely. Joining us now to discuss the implications of all this, Peter Shafrick, global macro strategist, joining us on RBC Capital Markets. Good morning.
Morning, Guy.
At the moment, European growth looks pretty good.
Yes, it does, actually. We've been talking about resilient economy for quite some time. If you strip out the noise about Ireland, Q1 has been pretty decent. Q2 has been even better. I definitely say we're looking decent.
Okay, so right now we're looking decent. Do we get an energy crisis, though? Is that what's coming? Abir's talking about what comes next. Is that what comes next for European growth and for European inflation? Like gas prices, we don't have enough gas in storage already. Is that what we're heading into?
I think that's the risk, because when you look forward, I mean, currently, and I think that's one of the reasons why oil prices are not skyrocketing, we're releasing storage. That's going to come home to roost eventually. I think kind of the same story will play out in the gas market, as you just pointed out. And one of the interesting things in this restart of the fight after the MOU was signed in the first place is that now gas prices are starting to rise much more than before, and it becomes much more of a talking point. I bet you if I'd been here, or when I've been here 3-4 months ago, we haven't been talking about gas, but now we do. And I think going into the winter, we'll have to see. I mean, our models suggest we're probably going to be all right, but storage is going to be extremely low, which means prices are probably going to have upward pressure.
Don't the earnings stories tell us, Peter, European earnings, that there are many out there who continue to underestimate the resiliency of corporate Europe, and that the corporate Europe can weather this?
Well, I think so, or we think so, and we've been saying this for quite some time. We think there's a fundamental resilience that we've demonstrated already over the previous years. That's number one. Number two, we do have extra investment coming, be that from the public side, potentially also from the private sector, although that remains a little bit elusive. And yes, of course, our earnings, as you've just pointed out, have also been resilient, or more than resilient. So that's a decent story. So for sure, I definitely think that the underlying fundamental economic situation is probably better than people give it credit for.
Where does that leave your view on the ECB and the reaction function of the ECB in that environment?
I mean, for the ECB, it's relatively clear in the near term. So they're going to hike in September again. I mean, that's what the market's pricing. That's what they de facto are telling us. I think that's the easy bit. Then they're at 250, which they have now said is the upper end of neutral. I reckon they will then try to pause for as long as they possibly can. And when you look at the latest research that they're putting out, they're saying, well, there's no second round effects. There's no indication that wages are going to go up. That's what they want to see, or rather not see. But that would be the trigger, I guess. The reaction function is predicated on that cycle between higher prices and wages. And if that's not happening, I think they can stay put. But we'll probably only learn that somewhere in 27. So I reckon after September they're going to stay put for a while, and then we'll see.
I mean, what does that mean for the rates outlook, though, in terms of it does seem like there's a higher floor on where yields are. And when you've seen the move, it's largely been real yields, not break-evens, that are driving it. And so, does it matter that you're having this difference in what's driving that move, and where can you actually get to?
So the way we've been characterizing this, I think, is an excellent question. Thank you. We think the risk in the bond market is very asymmetric. So it's very hard, in my mind, to really see a big bond market rally unfolding. Yes, of course, if there's some positive headlines, we'll rally 10, 15, 20 basis points, that's fine. And you obviously want to capture that. But to see like a sustained bond market rally for 6-9 months, where is that going to come from if the central banks won't be cutting? And surely that's very unlikely in this scenario. On the other side, we mentioned the gas crisis, potential gas crisis. We've mentioned higher wage price spirals through a resilient economy and all of that kind of stuff to the upside. And if that's materializing, and I'm saying if, then surely the risk is that they're going to hike more. So I think the risk in the bond market is very asymmetric in my mind. And we haven't even talked about a term premium story.
Well, why don't we go there then, in terms of it does feel like a lot of the issues facing bonds are global in nature, in terms of supply shocks that mean you have a flipping bond equity correlation, this huge amount of supply, demand for capital rising pretty much everywhere. Is there a differentiated view when you think about that risk compensation in Europe versus the UK versus the US?
So, I mean, first of all, if let's leave the corporate issues aside for a second. One of the things that's definitely there is a differentiation on different parts of the yield curve. And I would argue that the 10-year plus part of the curve, the ultra-long part, is the most at risk. And we've seen that before. We've seen bear steepening pretty much everywhere. And we've seen the reaction of the issuers, of the DMOs around the world, in skewing the issuance shorter. They're well aware, and there's all these stories that Besant wants to protect the treasury market as well. So I think that's part number one. Part number two, of course, is on top of that, you have, as you say, a lot of issuance from the corporate sector, the hyperscalers in particular. And obviously that's hitting like the big markets first, but they're trying to spread it around. We've seen that. So I think it's also, and we've seen sort of that part of the bond market also reacting. We've seen the CDSs of these guys rise and so on and so on. So I would say that is dependent on where they're issuing. But clearly, I think that the bond market as a whole is under pressure from all of these developments.
What are the liquidity implications of particularly the US issuing more at the front end? Where does that show up?
I mean, the liquidity in the treasury market generally is very, very good, as we all know. Yeah. So I don't think that the additional issuance at the short end is really that big an issue. I mean, you might see it a little bit in asset swaps and what have you. I think the longer end of the curve is a different story. But again, the treasury market is probably the liquidity or the lack of liquidity, as you seem to be alluding to, is not the issue for the treasury market. But we do see that in other markets, for instance. I mean, our market over here in the UK, for instance, we've seen very little issuance. So that's a bit of a different story.
Can I just jump in before Tom Johnson?
Yeah.
Do you buy this argument that Scott Bessent is worried about the Japanese selling?
I mean, it's not entirely unreasonable, but obviously what he also doesn't want to do is he doesn't want to sleepwalk into a situation where one day he has to react to an already unfolding crisis. So I guess staying in front of it makes a ton of sense. And a lot of people have been arguing, ourselves included, that one of the ways that you need to stabilize, like, global markets is trying to stabilize the Japanese market, be that in the currency market or indeed in the JGB market, which so far hasn't happened.
Peter Shafrick, thank you very much indeed for your insights.
Thank you for having me.
This Monday morning, Peter Shafrick, RBC Capital Markets Global Macro Strategist.
OK, what else do you need to know this Monday morning? Hiring at British businesses held steady in July, ending a downturn, stretching back to the Liz Truss crisis back in 2022. A survey from Recruitment and Employment Confederation and KPMG says temporary vacancies rose for the first time in 2 years, while demand for permanent workers declined at a slower pace. Berkshire Hathaway has spent around $4.5 billion buying back its own shares in Q2. It also purchased nearly $20 billion in equities, signs that the new CEO, Greg Abel, is putting more of the firm's cash pile to work. Operating earnings climbed 16%, driven in part by gains at the conglomerate's manufacturing and services and retailing divisions. Big focus on operations. And China is attempting to close the gap in the AI race with the US by tapping its $28 trillion capital markets. In recent months, regulators have fast-tracked IPOs for strategic companies and opened more avenues to raise money through bond sales. According to data compiled by Bloomberg, Chinese tech firms raised around $270 billion through initial public offerings and bond sales over the last couple of years. Kind of fits, doesn't it? In the US, there's a great piece out by Torsten Slok last week talking about the fact that effectively the AI build-out is being funded by investors, not by effective kind of sales to consumers. So we're still in that phase. So the Chinese are looking at that and
they're looking to emulate that. They have capital markets now that have matured. Obviously, they typically use things like subsidies and regulatory pressure. It's interesting. You've seen the big state funds coming in and essentially buying the dip when you've seen these significant sell-offs. There is still a lot of volatility, and it's going to take a lot to encourage retail investors in China to put more capital to play. But clearly, they're trying to use this to allow their AI companies. They've done a lot in terms of speeding up, getting to market, getting to IPOs. 8 months, 9 months. I mean, these are much shorter time frames in terms of allowing and adjusting the regulatory process so that you can get companies listing much quicker, particularly those that are seen as strategically important. And that's a shift.
OK.
Yeah, I mean, I just really wonder where that demand is coming from in terms of, like, if you think about the difference between China and the US, China has these big open models that are quite a lot less expensive. And so are people increasingly differentiating around, where I want to put my money in terms of, do I want to put it in the US where it's more expensive, or, is the right model not that for the use in terms of not the most complicated one? And Chinese equities have lagged quite significantly. So if you get that shift, I think certainly it could be quite positive.
Yeah, and there are risks. Clearly, there are risks for investors in China. There are risks for the government as well as they try to secure and funnel this funding into those companies that themselves are inherently risky, of course, as we see these models increasingly commoditized as well on pricing. Coming up, oil in focus as a deal to reopen Hormuz remains, of course, elusive. We discuss the latest energy markets moves with Amrita Sen from Energy Aspects. That insight and expertise coming up. This is Bloomberg.
Monday the 10th, good morning. 30 minutes to go until the opening trade here in Europe. Let's give you a sense of where we are. The futures picture looks a little like this right now. Asia overnight looked quite strong, but I think that's more of a reflection of what we saw Friday. This is the kind of the new start to the week here in Europe. A little softer definitely in London this morning, but broadly across Europe we're down 1/2%
OK, in the bond markets, European bond markets, there's some stability after the rally that we saw on Friday on the back of weaker labour market, weaker jobs data, of course, out of the US. You saw that rally, particularly at the front end in terms of treasuries. And today, European bond markets, again, relatively stable. You're seeing the 10-year over in Germany yielding 3.13, 3.91 over in France, and not much movement in BTPs as well, 3.90 currently. So not much movement ahead, of course, of that CPI inflation data out of the US. Not surprising that maybe you're seeing a little bit of stability in the bond markets. Now, oil pairing earlier gains as Iran and Oman remain short of a deal to reopen the Strait of Hormuz. Elsewhere in the region, Houthi militants have claimed an attack on a Saudi refinery near the Red Sea. Joining us to discuss energy markets and bring in the insights and analysis is Amrita Sen, founder and director of market intelligence at Energy Aspects. Amrita, the Iranians, good morning. The Iranians saying that they are getting closer to a potential deal with Oman. Of course, ultimately, the US would have to give its backing to that. We seem like we're a long way from that. What kind of deal would we need to see, would the energy markets need to see between Iran and Oman that would have a material difference in terms of flows through the Straits? What are you watching for?
Morning, Tom. For me, the main thing is it's not necessarily the deal in itself between Iran and Oman, because then Iran has gone ahead to say that this doesn't necessarily guarantee that Hormuz will open, because I think what Iran's asking for is blockade removal from the US, and they are essentially asking for a lot of guarantees, right? So I don't think we should confuse the Iran-Oman agreement with that. But yes, what the Iran-Oman agreement is talking about is the geographical route, which is what Iran is trying to establish, potential tolls, which is obviously extremely controversial as an issue, and generally like how ships need to coordinate with Iran to get in and out, right? And that's what they are trying to come to a conclusion to. The challenge remains, to your question about, what actually changes what's going on right now. If you look at it, we've got a trickle of oil flows or transits going through right now, right? About 5-ish vessels, perhaps, a day in and out. I mean, that's a fraction, and that's still at the higher end, by the way, of what we've seen recently. It was as low as 2, even at the end of July. It's picked up a little bit, in the early days of August, but it is very, very volatile. So we're not talking about, anything that's close to even the MOU levels, which was about 14 ships. So for us to really see that this is changing or moving, we need to see those transits pick up.
Does the pricing, Amrita, does the pricing make sense given that friction? You're talking about 5 ships possibly through the Straits right now, but we've seen that friction, of course, around the Red Sea as well. Does the pricing around oil make sense given what you're seeing in terms of flows, disruption, and inventories as well?
No, I think that's the short answer. We've definitely seen a lot of intervention directly and indirectly by governments around the world to keep prices down. But, the one thing I would say is that however much we try and keep crude down, in reality, products prices are the ones that have done the work to curtail demand. And that's what needs to happen. I mean, you've seen for the first time in the history of the oil market, heating oil cracks were at parity with WTI. Gas oil cracks were at parity with Brent. Ultimately, it's you and I consume products, whether it's petrol or diesel, and that is what has done the work. So cracks and products is where the real tightness is. I will say one thing. One of the reasons why crude didn't react as much as we saw, say, earlier in the conflict is because China had really pulled back. For the first time now in this conflict, we are starting to see Chinese crude imports pick up. I think that's something I would really flag we need to watch, because if that happens, we can really see a crude rally in the coming months. If not, products will continue to carry the burden of balancing the market.
I mean, let's pick up there then. I'm really curious what has allowed China to have that come down in terms of not using as much oil. Is it demand destruction? Is it reserves? Is it kind of a combination of both? And if it is reserves, how much leeway is there still there? Are we approaching a kind of tipping point, or is there a lot more to go?
No, actually, great question. It's a combination, like you say. It is a combination of them using reserves, which is about 1 million barrels per day, and the 3 million barrels per day, which is run cuts, is a combination, again, of them really having a lot of overcapacity in petrochemicals, which then allowed them to run down those inventories. A lot of China's refineries, unlike in the West, actually are simply, they process crude and they make petrochemicals. They also banned product exports. China is a big exporter of products, which then meant that they can run less crude oil. And finally, the demand destruction we've seen, quote unquote, it's about 500,000 barrels per day. So that's not that big in the grand scheme of things, but you have to add all of these up. The two things that have changed, the government is now allowing product exports again, at least for August, and petrochemical stocks are so low that they need to run again to replenish that.
I'm wondering then, what is the catalyst for getting a higher oil price? Is it that we get to certain levels in reserves? I know some places have been depleted quite a lot, like the U.S., but, what kind of triggers the reaction in the market? Because in July, it was very much just a kind of grind up. Is that what we get rather than a sharp move?
I do think grind up is more likely these days, also because, remember, traders and investors have been really badly burned positioning in crude because of the volume of headlines that we continue to get from the U.S. administration, from Middle Eastern governments, trying to prove, either trying to get oil prices down or trying to prove that their production ramp up has been quicker, etc. So I think that pressure is going to be there. So that's why a grind up is more likely. But this is why I keep saying, if China comes back, instead of importing 6.5 million barrels per day, 7 million barrels per day, if they are going towards 9, which is where we think they will be in August, or 9 plus, I think that's a big shift. So I would watch for that. And SPR, like you rightly say, heavily depleted. And also, SPR flow rates are now slowing down. What used to be in the US, say 1.5 or 1.4 million barrels per day of outflow is now more like 500,000. So I think that in itself is a big deal, because any disruption means that the buffers, while they're there, it's at a slower pace at which it's coming out now.
Amrita, good morning. It's Guy. Can I just take you back to the products story? Where is the biggest inflationary impulse likely to come from within products? Is it diesel? Is it jet fuel? Where do you think we are underpricing most?
Great question. We just put out a piece on the 10-year in the US and products, because one of the things, and there's a great chart we put together where you can see 10 years has completely decoupled from crude. And guess what? It's actually been driven by a lot more. It's diesel. Because diesel actually has a bigger pass-through in the US in particular, with trucking and how that kind of passes through to consumers. Gasoline, the rate of change matters. But again, just the way the CPI is kind of designed, it's not as big an impact. I mean, diesel is the tightest in the market right now, and it will be as long as Hormuz flows remain disrupted. Let's not forget, Russia's also banned product exports, and diesel they are a huge exporter of diesel, used to export over 1 million barrels per day, and now they are down to a trickle, barely anything. So those things are tightening markets. Again, China allowing product exports helps a little bit at the margin, but it doesn't solve the problem.
So how much upside could there be still in diesel?
I think right here, right now, I would say with the China news, things should come off a little bit. But fundamentally, let's say, we get less headlines of a deal in Hormuz. I think we think, in the coming weeks, it can go up again. Remember, at least gasoline, we are coming towards the end of the summer season. It will also be tight, don't get me wrong, and high prices. But diesel, we are going into winter, which is peak demand period. We've lost GTL from Qatar, which is a very important crude diesel quality for the winter. I think we are underestimating just how tight diesel can be this winter. So this upward pressure might be okay for the short term, but in the coming months, we do think that can accelerate again.
Amrita, a challenging winter then from Europe, particularly when it comes to gas inventories?
Yes, gas is another one, by the way. I'm glad you raised it, because, again, we aren't going to hit the threshold we need, bare minimum, in terms of what you need for the winter. So if you imagine diesel prices are high and gas prices are high, Europe, but I would say US, of course, we don't expect gas prices to go up given the abundance they have. But diesel is still going to be very, very important for them from an inflationary point of view. I think the way I would look at diesel is that it's going to need to trade on a flat price basis. So forget what the crack is. The more artificially crude is lower, the higher the diesel flat price needs to be, which is around $160 to $180 per barrel, to really start to curtail demand. But again, natural gas, TTF in particular, we do believe there's upside in the winter in Q1, given how depleted the stocks are.
Amrita, great stuff. Thank you very much indeed. Amrita Sen, updating us on the energy story, Energy Aspects founder and director of market intelligence. The implications for inflation are what? Well, potential upside still in the markets, according to Amrita. Investors post the payrolls print on Friday, certainly debating the direction for the Fed.
Can you still get it done this year? I think so. But listen, I mean, I think you have to. One thing I've learned about investing, it's not what you think they should do. It's what they're going to do. And today, the structure of that committee clearly is we're going to fight inflation and use the rate tool to be that tool to get there. So, listen, I think they still could. I just think hiking doesn't make a lot of sense today.
Rick Reeder, BlackRock's CIO of Global Fixed Income. Of course, we're going to have more on the Fed following that jobs report ahead of CPI this week, of course, as well. That's next. This is Bloomberg. Fifteen minutes to the cash equity open this Monday morning. How are you doing? This is what the equity market story looks like. London looks like it's going to underperform a little bit, but elsewhere around Europe, we're down by 0.1%. I would ignore Asia this morning. Asia's more of a reaction to what we saw Friday in the United States, which was a strong end to the week on the back of that payroll number. Bad news, it seems, at least for equities still, is good news, Tom.
OK, let's dig into what Berkshire Hathaway and its moves are telling us about their appetite, that conglomerate's appetite for global equities then. Second quarter earnings show that the firm spent about $4.5 billion to buy back its own shares and purchased nearly $20 billion of equities in the period. That increase in capital deployment is a sign that CEO Greg Abel is putting more of the firm's cash pile, massive cash pile, of course, to work. Let's get more from Bloomberg Managing Editor for Finance in Europe, the Middle East and Africa, Tom Metcalf. Tom, what did we learn then from the earnings and how they're deploying capital now with Greg at the helm?
Yeah, I think that's probably the most interesting question to ask about Berkshire Hathaway. I was speaking to someone over the weekend, and you can look at this two ways, right? Yes, it went out, bought $20 billion, and I think of that we know they went into Alphabet, Tokyo Marine, don't quite know where the rest came through. But the other element of that is, as you say, there's a gigantic cash pile still left. I think it's close to $400 billion. And, the person I was speaking to says, this has been a long-running thing for Berkshire, but that is sort of a slightly, if you think about it, depressing element in that they can't see those opportunities out there, famously value investors. So it depends. It does look like a shift under Greg Abel, but equally there's not a clear answer.
Is it that big a shift?
Well, yeah.
The huge amounts of money still on the balance sheet, still to be deployed, as we've just pointed out. How big a move really is this in terms of if you were a new CEO looking to come in and make a splash? Presumably you do a bit more than this.
Yeah, I think that's a fair point, and it's seemingly much more business as usual, and that's probably music to most Berkshire Hathaway shareholders' ears. And the buyback, $4.5 billion. That's obviously a bit of a shift, but I think our crew at Bloomberg Intelligence are expecting much higher than that. So again, it just goes to show, like you say, nothing's really shifting, and you can probably expect kind of Warren Buffett style sort of approach going forward, as I say, most people who back Berkshire Hathaway probably want to see.
So I guess the question is really, why did they do it? Is it because of valuations changing? Is it the opportunity set? Is it because of the leadership change? It seems like you don't think it's as much that.
Yeah, as in the buyback. Yeah, I mean, look, it is a shift, right? But, again, it's kind of probably caution is the watchword, right? So they're keeping all the options open. It should help support the shares somewhat. But, again, expectations are everything. So if people were hoping to say, $10 billion buyback, this is probably going to be taken somewhat negatively.
Tom, nice. Thank you very much indeed. Tom Metcalf, reviewing the Berkshire Hathaway weekend news. OK, let's turn to today's markets. Markets in 3 minutes. Adam Linton is joining us from our MLIV team. So, quiet start, but getting busier. Got a few earnings coming up later this week, but CPI looks like it's going to dominate this week.
Yeah, obviously, we're coming off the back of that, slightly softer non-farm payrolls release we saw last week. But ultimately, we kind of saw the bid in treasuries fade into the close on Friday because they know that this CPI report is looming large. If the Fed is to do anything, it's very much going to be off the inflation mandate, not necessarily the labour markets, given that inflation has been running above target for about 5 years now. And, I think in terms of kind of how the market will trade it, I think there's probably a higher sensitivity to a hot report. We saw that FT report last week suggesting that Washington is going to look to reinforce the messaging on inflation. So that does potentially set us up for a slightly more hawkish Jackson Hole. In terms of where market pricing is at the moment, it's a relative coin flip between whether they do or don't go. So you do feel that one way or the other, this will tip things to some extent. Of course, we still do have another report by the end, before the upcoming meeting. But in the event we do get a call report, obviously, we'd expect to see a bid in treasuries, but events in Iran could potentially put a bit of a cap on that.
Well, on Iran, $83 a barrel right now, 83.47. You're down a tenth of a percent on Brent. Is this a market that only cares about the extremes, the complete reopening, or a return to significant conflict? Because right now it's just been bumbling around that $80 to $85 level. In fact, over the last 2 weeks, oil is a little lower, and we've seen the gains in the last 5 days or so, and currently around 83. How important is the current status quo for the inflation story?
Yeah, I mean, if you look at since the start of July when things really broke down, we've kind of done this 70 to 100 range. And as you mentioned, we're kind of in the middle of it, kind of middling. I think on the short-term bias for oil is probably upside in the near term. If you look at the 10 of news flow over the weekend, you've had Iran saying no direct talks to the US. We've seen a security shake-up. We've seen even reports that Khamenei's now on the scene. I think, you could potentially get a jolt lower this week. It looks like the next thing is potentially this Iran-Oman deal. But ultimately, that could probably be a bit of a short-term move because it won't get the Strait reopened. And the market just really cares more about whether getting a more durable US-Iran deal. And even then, though, for assets, the bar to reprice anything more optimistic is a relatively high one, particularly if you look at European government bonds. We saw in Sintra, even when things were looking better, the ECB was still particularly cautious. So that does definitely place a cap on things.
Okay, I'll just finish up quickly. We're watching the yen quite closely, obviously. It's not gotten a huge gain from that weak non-farm payrolls report. Is the path of least resistance still towards a lower yen and higher dollar yen?
Yeah, I think so. I mean, if you look at the price action today, we're above 150 and we're going. Yen's the worst performing G10 today. It's worst performing G10 this month. Even euro-yen, in which the transactions were conducted, that's moving higher. So the market's verdict appears to be, yes, it caused a bit of a short-term demand jolt in dollar-yen, but at the moment, they're happy to keep reloading up and buying a dip in dollar-yen. And I think if we get more of a runway whereby the market is like, oh, this is it for the yen, for the latest intervention efforts, then this momentum can keep moving to the upside, particularly in a world where the BOJ isn't really doing a great deal and the Fed is still priced hawkishly.
Adam, thank you. Bloomberg Markets Live's Adam Linton. Remember, you can get up-to-date analysis and insight from Adam and the rest of the team. Just go to MLIV Go on the terminal. Let's get your stocks to watch this Monday and bring in Louise Moon, who's standing by. Louise.
Morning, Tom. First up this morning, we're looking at chips here across Europe, obviously on the back of TSMC's results overnight. In Asia, strong earnings from them, reporting a 45% growth in monthly sales. Strong forecast as well for the year. So seeing if this will play through into the European market, the usual suspects, ASML, Infineon, ST Micro, obviously have been surging, but there's been some recent volatility there in the AI space, so potentially TSMC could calm those worries slightly. So we'll be keeping an eye on those ones as markets open. Now, next up, we are looking at UK recruiters. There's been a fresh report saying that jobs, or the hiring for jobs, steadied in July. Now, this is capping a downturn that we've been seeing for 45 months, so since the Liz Truss crisis in 2022. So obviously, recruiters have had a lot to contend with. They've had, the impacts of the Iran war, as well as more domestic factors, political upheaval, and rises in employment costs. So that's been really hitting recruiters over the last year and longer. You can see this playing out in their share price over that period. So potentially this could add a bit of a ray of hope there for the job sector and could boost their shares at earnings this morning. But again, we'll be keeping an eye on that. And then finally, a quick one on GEA Group, the German manufacturer of dairy farm equipment. Had a bit of a rocky year to date so far, but posting a strong second quarter, strong results, strong free cash flow. Analysts saying, that balance sheet could potentially help boost a bit of M&A activity. And the analyst ratings are also strong. If we take a quick look at that, you can see that there's about 13 holds, which is the majority there. Yes, so 13 buys, 7 holds, 2 sells. So strong there from analysts. So again, keeping an eye on that as markets open.
OK, Louise Moon, thank you very much. Did you say that's a dairy farm company? Or did I mishear that? Louise Moon, thank you very much indeed on the stocks to watch. So semiconductors in focus, as Louise was saying, TSMC reporting a 45% rise in its monthly sales. That AI hardware story is still there. And we'll see if
Does that
some
feed
of the
through
European
to SML
names,
this morning?
logically, you would think it should. It doesn't always. We've seen in the past where strong TSMC sales don't always reflect well for ASML, but you would have thought that this number is going to be a positive for a company that provides the machines and the equipment into those fabs.
I'm just trying to look for catalysts this morning. It looks like the European equity market opens, looks quite quiet. I'm trying to understand where the FTSE is going to underperform. But it feels like it's going to be quite a slow start to the week.
Yeah, I mean, absolutely. I think we're just mostly watching the oil price, seeing how that feeds through. I mean, inflation being the main print. I'm kind of still thinking about non-farm payrolls and how that feeds through into this week, in that, is bad data good? Is it because we have, what is the break-even rate of employment in the U.S.? Does that mean that we're more worried about a softer retails print if it means, slower growth and that feeds through to equities?
So 4.1% was the unemployment number, so that was unchanged. But there's revisions.
Down, no?
It was that came down.
Yeah.
So 4.1% is down. But it's the revisions that were really significant for the previous 2 months as well. And just there is a smaller workforce now and labour pool in the US.
But that should support wages. I know wages sort of kind of moved a little bit, but in theory that should support the wage story going forward. If it does, then does the Fed need to focus on that? Or can the Fed focus on inflation, which is what Walsh is signaling that he's going to do?
I mean, I think the real worry is that that you have inflation in the pipeline, and it's what you say, it's the wages, whether or not that becomes persistent. And certainly you have 20,000 jobs added as the current pace over the last 3 months. That's the average. And that could be your break-even rate. It could be okay.
We're on our own now, you know that. Next hour.
It's a terrifying prospect.
Skylar's going. She's got other things that she needs to go and do. Back tomorrow. Back here for the next 2 weeks. So we're okay. For the next 2 weeks, we're okay. But for the next hour, it's going to be touch and go, I can tell you. Anyway, we've got around 5 minutes to go. The opening trade is coming up next. Futures pointing to a fairly flat open here in Europe. We'll be back in a minute. Skylar's departing, but she'll be back again tomorrow. Fear not. This is Bloomberg. Okay, here we go. A couple of minutes to go until we start cash equity trading here in Europe this Monday morning. Quick recap. This is what Friday looked like for the S&P. Now, what this doesn't account for is the gap, obviously, first thing in the morning, the gap higher. We get positive payroll data. That feeds through into these markets. They push higher towards the end of the day. Europe, though, goes out around here. And actually, we're a little bit lower by the end of the day over in the United States. So maybe that accounts for some of the story that we're seeing in futures first thing this morning. There's not a lot, really, of clarity, I think, from the futures picture here in Europe this morning. Doesn't tell you a lot about where this week is likely to go. All it tells you is that we're just kind of marking time, I think. Euro Stoxx 50 futures, nothing to see here. FTSE's a little softer this morning. There we go, unchanged. DAX down by less than 0.1%. There's a few single stocks out there that are worth focusing on. I think that may be where the story lies today, rather than necessarily at an index level where we are continuing to watch the macro picture unfold, but with not a great deal of certainty, with oil prices in flux, and obviously we're waiting for that big CPI print Wednesday, Tom.
Let's zero in on some of those individual names and the individual stocks that could be on the move, and sectors as well. We're looking at the chip sector and the chip space, so names like ASML, Infineon, of course, ST Micro as well, on the back of some pretty decent numbers out of TSMC, sales rising, and that foundry company, of course, by around 45% in the quarter. So we'll see if there's a read across, an uplift, a positive uplift for some of the chip stocks in Europe on the back of that. UK hiring data not degrading after 45 months or so of a worse hiring situation. It looks like there's modest improvements. We're watching UK recruiters on the back of that. And GEA Group coming through with an adjusted earnings picture slightly better than the estimates. Watch that company as well, Guy.
Okay, let's price all that in, figure out what it looks like this Monday morning. This is what the opening trade looks like. Let me show you some numbers. FTSE 100 was expected to be down by 0.3%. At the moment, it's up by 0.1%, so maybe not what the futures were signalling. We'll see how it goes in a minute or so, and see whether actually it dips into negative territory as anticipated. Stock 600, nothing to see here. Below the surface, there are some stocks that are going to be worth focusing on. We'll get to Tom in just a moment as the FTSE ticks negative. The AEX, I wonder whether it's positive because of ASML. The IBEX is down, but again, not by much. The DAX is up 0.2%. Again, was expected to be flat. I would say if you are really, really looking for a glass half full kind of story this morning, it could have been worse. We could have been down 0.2%. We're down by less than 1/10 of 1%. Maybe I'm reaching here, but that's kind of the narrative we're looking at first thing this morning. Basically, at an index level, Tom, we're going nowhere in a hurry.
OK, well, you talked about ASML and what we're seeing on the AEX. So ASML is playing that role. It's currently up 1.2%. So a decent move for a company with a market cap, of course, of that scale and size. On the back of decent numbers coming through from one of its key clients, of course, TSMC. So tech as a sector is up 0.6%. It's the best performing sector so far. Healthcare gaining 0.4%, basic resources up 0.3%. Majority of sectors, though, in negative territory, not by much. Food and beverage is the biggest loser right now across your sectors, down 0.4%. Top of the list, then tech up 0.6%. A bit of a positive uplift coming through from the numbers from TSMC. And again, ASML is playing that part, Guy.
Yeah, it's ASML. In terms of the biggest points gains, it is the biggest points add. But you've also got Infineon doing relatively well this morning. It's certainly helping out on that narrative. Schneider's in there. ABB's in there as well on the kind of AI data center build-out, electrification, transformation sort of story. So all of those stocks are definitely playing their parts. So tech is by far and away doing the heavy lifting. So the banks are quite mixed this morning, which I think is interesting. You've definitely got some downside within the banks, and some of the industrial names are softer as well. So Airbus, BAE, Rolls, these are kind of Safran, those kinds of industrial names, maybe showing some signs of weakness this morning.
OK, let's get more analysis across these markets and bring in Dan Scott, CIO and multi-asset head over at Vontobel Asset Management. Dan, good morning. Thank you for your time. So global stocks back to near record highs. It's a bit lacklustre in the European session. We wait, of course, for inflation data out of the US later this week, CPI on Wednesday. What is your level of confidence that global equities can continue to grind higher from here, Dan?
Tom, thanks so much for having me. Pleasure to be on the show again. So looking forward from here, it's a very pertinent question, because increasingly you need to get a bit uneasy about the complacency that you have in markets. We still have a cautious overweight on equities, still invested in equities. But if you look at things like non-farm payrolls, you can see that there are some cracks. And it seems like markets are a little bit schizophrenic, if anything. Honestly, things that we've been looking at for years to gauge where we are in the economic cycle, like Michigan Sentiment Survey, which, if we believed it now, would be pointing towards a recession, I think just show that, nowadays you can't just have beta exposure and hope for the best, because very clearly there's a divergence. There is U.S. consumer spend, which is actually doing quite strong, but only from the wealthiest segments. And down below, towards the lower end, is where you see then also what we just learned from non-farm payrolls. You actually have a drop in the number of jobs added. So things aren't necessarily going perfectly all the way through. However, the amount of fiscal stimulus that we've seen and AI capex stimulus we've seen has gone pretty much straight to corporate balance sheets. And I think that's why it makes sense that if you look at any of the indices, whether it's the S&P 500 or NASDAQ, whatever index you want to choose, almost the Russell 2, trading at around 20 times. So not necessarily expensive. The question is really just how you want to granularize your exposure there on equities, where the further upside comes from. And then we start having discussions about AI and private credit as we try and deal with the nuances here on how to be exposed to any further upside from here.
Where does Europe sit in that granular exposure then, given the relative resilience we're seeing in the economy, given the decent earnings growth we're seeing for corporate Europe? Where does that sit in terms of how much exposure you want to be getting to European equities?
Yeah, so, I like Europe. We're neutral in terms of our positioning right now to our SAA on European assets. I like Europe just because valuations are not as high here as they are in the US, so there's some valuation upside still. It's more of a cyclical recovery play if you wanted to gain exposure. So the headwinds, if anything, are structural reform. And honestly, for the past 25 years, I've been talking about the need for structural reform in the Eurozone. So I imagine that's going to continue to be a headline. That Europe just lags in terms of the structural reforms it's willing to push through. We haven't reached the political catharsis yet for the Eurozone to really push through meaningful reform. On the other hand, I think that, as energy costs go back down again, and hopefully they will, then the Eurozone at least is able to recover a bit in terms of its industrial recovery. And on the AI front, the reason why it's been lagging is because, on the intelligence layer is where it doesn't necessarily have much of the exposure. But if you take a look at what's been happening to token prices, Google, AI, Anthropic, they've all been cutting token prices dramatically. And part of that's because of competition from China, like DeepSeek and others. But really, I think what it shows is that you're starting to get a commoditization of the intelligence layer. And it's starting to look like, it's the infrastructure layer where most of the profits are going to be captured. And Europe has plenty of exposure there, of course.
Dan, morning, it's Guy. We try and analyse these markets kind of rationally, fundamentally. But is that the right framework? Because, again, last week just seemed to prove the point. It just depends on how much leverage the hedge funds, the pods, are prepared to put on. It depends what's happening in the options market rather than what's happening in the cash equity trade. Aren't fundamental investors just being driven by what is happening with those kinds of metrics rather than anything else? They try and sort of act rationally. They try and talk about, the market's being complacent. But we're all being pushed around by just how much leverage there is out there. Isn't that the only way to look at what is happening here and act accordingly?
Absolutely. That's why you need to position because, like you say, money supply, leverage, these things are all driving the markets. And the outlook for these remains fairly benign. Rates really aren't restrictive, are they? And we're looking at a situation where now we're starting to price out a September hike from the Fed. So it doesn't look like things are going to get much tighter in terms of monetary policy. And then you have to wonder, so let's look at health of balance sheets. And actually, corporates still look very healthy on aggregates. But if you look at, for example, lending, you can see that there are some cracks emerging. We've watched it in the private credit space, and that's why issuers are coming back to the bank loans markets. Where you see some cracks, though, is in the triple Cs. That segment is starting to look like, it's not doing as well. And so that's really where the strain's going to come from. It's early days. It's really quite far out on the horizon right now, as it seems.
OK, so that's the point that John Authers is making in his piece this morning on the Bloomberg terminal. It's a point that Torsten Slok has been making as well. You look at what is happening in the credit space. Is hyperscaler credit, is AI credit the metric that you want to watch in terms of how worried this market really is, rather than looking at the stock market and using it as a way to judge sentiment?
Absolutely. I think it has a lot to do with money supply and who's tapping and where we are in the cycle. So if we want to use the dot-com bubble as the playbook here, then we need to be very vigilant on balance sheets and leverage. And so far, things actually looking quite healthy, although we've had a pretty historic swing from, massive amounts of cash on balance sheet to being just about, neutral. And then starting to tap debt markets has happened very quickly. Leverage isn't an issue yet, but it very quickly could become one. So that's something that needs to be watched because so much of the stimulus for this market is coming from the stimulative effect that you have from that cash on balance sheet having been spent. That's something that creates these massive wealth effects, which then in turn drive U.S. consumer spend and other consumer spends. The amount of wealth being created by this massive spend on a new technology that hasn't really proven itself yet, or at least hasn't matured anywhere close to, that's the thing that we need to watch. That's going to be a rocky ride. So far it's been smooth sailing because it's just all been big spends. But at some point, it's going to get a bit more volatile. So that's why we'd say the outlook right now for equities is good. Remain overweight equities. Modestly, we express it through an overweight emerging market equity. But it's also time to be looking at income and more defensive ways of being exposed to markets. Because, on a multi-asset portfolio, if you're up 10% year to date, balanced, mid-August, you're doing pretty well historically, and maybe you shouldn't get too greedy. Maybe it's time to look at some downside protection, at some hedging in the portfolios, or at least running a barbell strategy.
Dan, do you find protection at the long end of the yield curve? What level of yields are you looking for on a risk-adjusted basis? When does the 10-year, 30-year start to look attractive?
Yeah, thanks so much for bringing this up. This is another one that confuses, right? I mean, you see yields up and then the dollar not stronger. Things just not going by the historical rhythms that we're used to. So, I find fixed income increasingly difficult as the, traditional way to hedge the portfolio. Obviously, I still have treasuries and portfolios and other traditional fixed income debt. But the debasement trades, even though it's had a difficult time this year with gold not really performing, I don't think that debasement trade is dead. I think G7 indebtedness forever is a topic. And so therefore, I think really you want to be exposed to liquid alts. Whether that is, a merge ARB fund or whether it is a catastrophe bond or some gold in your portfolio or just commodities in general. I think are a way to get diversification and some protection for portfolios.
We're going to talk about catastrophe bonds in the show a little bit later on. Thanks for the tease, Dan. Dan Scott, Vontobel Asset Management CIO and head of multi-asset over there as well. Quick look at the core six. This is what is happening. This is the picture we find ourselves with. A story around chips certainly dominating. Louise is going to talk about that in a second, but you can see ASML up at the top of the pile this morning, doing quite well, up by 1.3%. So let's get some more detail around what is happening there. Louise Moon is here with more.
As you say, chips are dominating this morning. ASML, Infineon, ST Micro, all the usual big names rising into the green as markets open, obviously on the back of TSMC's earnings overnight and that calming some of those worries in the space. So all higher into the green across Europe. Away from chips, we're also looking at the UK recruiters, so the likes of Hayes, Michael Page, Robert Walters. This is after hiring steadied in July, ending a 45-month downturn for the industry. So boosting Hayes and Michael Page, not quite for Robert Walters, but these two into the green after that. So a bit of hope there for the industry after that report this morning. Sticking with the UK, we're going to also look at Plus 500, the online trader. Shares quite a bit higher, almost 5% higher. Now that is after their first half earnings, saying that it was outstanding. Customer accounts boosted almost 10%. So really, really benefiting their shares up almost 5%. And then finally, a quick look at Vistry, the home builder. There's been a report that one of their credit insurers is cutting cover on some of their suppliers, and that is really weighing on their shares, down almost 7% into the red.
Louise, thank you. On some of the stocks on the move this morning, Louise Moon with that roundup. Coming up, a spate of rogue AI attacks is pushing cybersecurity to the forefront as companies look for round-the-clock defence against the new threat. More on that story next. This is Bloomberg.
"17 minutes into the equity market session, this is the picture. As you can see, we are not going anywhere in a hurry, to be brutally honest, at an index level. Below the surface, though, there's some quite interesting things happening. Chips are certainly where the action is this morning. ASML is leading. We'll come to the details as to why in just a moment. Elsewhere, you've got Pharma having a fairly good morning. Astra's up, Roche is up, having a fairly good day. But it's hard to get a sense at a sector level, other than tech, of anything really kind of giving us a clear kind of line of sight on where we're going.
Well, let's show the European tech names then, because there has been a bit of a lift forward, a bit of a pull forward in terms of the numbers, in terms of the stock reaction on the back of these TSMC sales. We'll get the details shortly. But you can see, as Guy was saying, ASML up 1.5%. You're seeing the Nokia's benefiting, Infineon as well, as is ST Micro over in Paris, up 1.7%. So TSMC reporting a 45% rise in monthly sales, in a sign, of course, of sustained demand for AI hardware amid that market volatility that we saw that was so pronounced in July. The report comes after TSMC raised its spending projection for the year last month, when it faced questions on whether its AI-related expenditure would deliver meaningful returns. We're joined now by Bloomberg's senior strategist, Neil Campling. Neil, walk us through the numbers from TSMC. We are seeing a bit of a lift, then, for European names on the back of this. It seems to be read positive by the market so far.
Yeah, so 45% for the monthly sales data. Analysts are at about 47% for the full quarter when it comes out. To put that in perspective, for a $1 trillion company, it's a pretty high growth rate. And it's on track to be the highest top-line number since Q3 2022, so the best in 4 years. So that's very supportive of that, helping the chip equipment stocks today in Europe. And for those chip equipment stocks, let's remember that we have the likes of Applied Materials, ASML's closest comp really, reporting results later this week. And we'll get other AI clues from other earnings in the US this week.
Who does TSMC make chips for? Just because this is the critical thing here, really, isn't it?
TSMC are making the AI chips for NVIDIA. They're making the chips for AMD. They also make the chips for the smartphones for Apple. So they're not the memory trade, which is where there's a lot more volatility around. These are the core logic, the brains that go into the AI systems and that go into...
Why are we getting less volatility there than we're getting in the memory?
Because memory is more cyclical over the course of longer cycles. And also in memory, they're all raising their own CapEx forecasts. Yeah. And that's actually going to impact in terms of the supply side dynamics and probably pricing going forward. Meanwhile, AI tokens have come down about 40% from the highs. So the actual use of the AI tokens is getting a lot cheaper. And there's a disconnect between memory pricing and token pricing at the moment. And I think market participants are betting that the sort of supply going up in memory means that pricing for memory, DRAM in particular, will come down over time.
Yeah, over time is the question, isn't it? Over what kind of time frame? TSMC, the read across in terms of sales from other foundries, the likes of Samsung, do we expect Samsung to perform it similarly well in terms of the sales numbers they're seeing, particularly when it comes to the GPUs?
We certainly would, because Samsung also does not just memory but logic as well, and it has a leading edge fab out in the US, giving it a good local footprint in the US market. So TSMC and Samsung are the two leading logic foundries that should be benefiting substantially from this high demand and these high growth kind of estimates that are out in the marketplace. So it's positive for both, and definitely I think investors prefer that to the memory cyclicality.
OK, so the big question around all is the AI trade back on? Because it was off for a while, and it feels like it's back on again. Is it back on again?
It was off for a while you were sort of sunning yourself out down in Cornwall, Guy. And I think part of it is because we got the accelerating growth coming out from Microsoft. So to justifying that CapEx, we had good accelerating growth coming from AWS, from Amazon. So there's definitely some comfort from there. But the big question about when we're going to see these big returns on the invested capital from these hyperscalers does remain to be seen. Not all of them can benefit from the AI build-out, but there's certainly some encouraging signs in the meantime.
Yeah. We'll wait and see. The one note that while I was on holiday, I read was the one from Torsten Slok talking about the fact that basically kind of the growth is still being funded by investment. It's not being funded by sales to consumers at the end of the line, which is you've got to get to that point.
It's like Anthropic. They're looking at, their sales, their ARR. I mean, the sales are incredible for Anthropic, and OpenAI is not far behind. So you're looking at potentially $100 billion of sales from $10 billion last year. So $10 billion to $100 billion this year for Anthropic.
Is that enough to? Because at the moment it looks the hyperscalers are cash flow negative. So at the moment, that's where the money's going. It's going up the chain to TSMC. It's going up the chain to NVIDIA. At some point, you need to have it coming into the hyperscalers, then going up the chain. That seems like the missing piece in the puzzle right now. Anyway, Neil, thank you very much. Updating me on what we saw last week. Senior strategist Neil Campling. Let's talk about another aspect to all of this, which is the recent spate of rogue attacks by three makers of sophisticated AI models that has put the potential threat of this new tech back into the spotlight. It's been a story over the last few weeks. An attack on Hugging Face obviously made the headlines. That was an OpenAI model. We saw similar breaches reported by Anthropic and Meta, fueling calls for more thorough safety when it comes to AI models and how we test them. Let's talk to Bloomberg's senior cybersecurity reporter, Jordan Robertson. I thought a sandbox was meant to be secure. How are these things getting out? Do they want them to get out? Do they not want them to get out? How tight is this?
Yeah, it's been a fascinating couple of weeks. I've written about cybersecurity for a really long time. And to your point, I never imagined I'd be talking about sandboxes.
Yeah.
At this stage of the cybersecurity industry, sandbox is a piece of software that you use to run dangerous software inside. Protecting it from the internet is very well understood science. To answer your question, the reason these rogue AI models have gone rogue in the first place largely has been because of mistakes by the tech companies or their third-party providers in allowing these things access to the internet. Now, sometimes those mistakes were kind of intentional. Like, in order to understand what these models do, in some cases, you need to see what they look like when connected to the open internet. And now you're supposed to monitor that, and you're supposed to protect against harm on the internet, and they didn't do that. So you're seeing some very basic security mistakes from some of the wealthiest tech companies on the planet. It's kind of mind-blowing.
Okay, so that part of it, that part of it is maybe a challenge when it comes to the regulatory field as well for these frontier labs. Do we expect, so we OpenAI, Hugging Face, then there were reports that other models, other frontier labs had similar breaches. Do we expect more is this just to be expected, more to come as they test these increasingly powerful models?
Yeah, absolutely. I mean, we have no idea how many of these incidents are happening right now on the internet. We know of a few examples that these companies have disclosed. There's almost no visibility into what China's doing with its AI tests and how many of those tests may have gone rogue or not, or how many other tests from these, American and European tech companies may have gone rogue. There's just no good way to measure that. So we know of a few examples. We know these models are incredibly powerful and creative, too. Like what we've seen in the last couple of weeks has been these models exhibiting extraordinary creativity and ingenuity and imagination in kind of how they proceed toward their goals. And the reason for that is they're trained on us. They're trained on humans and books and TVs and movies and things like that. And so anything a human is capable of in terms of exercising its creativity, these AI bots in theory could do as well. And we're seeing that now for the first time play out. But we've never seen that before.
I was listening, Lizzie talked to you a little bit earlier on, and you said, did I hear it correctly? These guys outsource this work to some third-party company.
There's a third-party company at the heart of many of these incidents that we're talking about. It's called Irregular Security. It's a new startup. It's built by experts in machine learning. So a lot of these companies, again, I've covered cyber a long time. A lot of the players have been very familiar until right now. They've been cybersecurity professionals. What we're now seeing is companies like Irregular Security that are machine learning and AI experts getting into security. So they're expert and they're amazing at AI, but they've made some very basic mistakes on the cyber part. And so Irregular Security, what all of these companies have said was that there was a miscommunication with Irregular Security that allowed these AI models to access the internet. Now, again, there can be good reasons to allow these things to access the internet. In this case, the tech companies are saying there was a miscommunication with this provider.
Sounds like we need some regular security.
Yeah, I was about to say the brand, they may be considering a name change at this point, Irregular Security. All right, Jordan Robinson with a really interesting breakdown on what we're seeing in terms of these cyber attacks and these breaches by some of these frontier models. Bloomberg's senior cyber security reporter. Coming up, as Europe grapples with wildfires, we're going to talk to Tanya Roche, head of cat bond portfolio management at 12 Capital, about the rise of catastrophe bonds. That is next. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into your Monday session. Across the benchmark, that Stock 600 essentially flat. Maybe there's a bit of a holding pattern ahead of that key inflation data out of the US on Wednesday. The DAX is up just 0.1%. The laggard is the FTSE 100, down just 13 points so far. Over in France, the CAC current is flat as well, 8,713. There's a little bit more interest when it comes to the tech sector, where you're seeing a little bit of a gain. Guy?
You know, I said it was a quiet Monday. Okay, it's now a quiet Monday, and I have data to back that idea up. Look at the volume. We're down really sharply. You can see that in these figures. In terms of the way that the market breaks down, it's kind of 2 for 1 nearly in terms of the losers versus the gainers this morning. Tech is doing a lot of the heavy lifting on the upside, but volume is super light. We are mid-August. We have some catalysts later on this week, but we're not there yet. TSMC is a catalyst, though, first thing this morning. Nordic Semi is one of those that is responding to that catalyst and is outperforming along with the rest of the chip sector, doing fairly well. I saw a note talking about plus 500 as well, talking about the idea that maybe it has turned a corner. That's one of the stories out of London as well. And if I take a step back, you can see Imovio. I think there's a Bernstein upgrade in the market this morning on that related to the car sector story. So it is up 4.5% on the back of that. Plus is up by 5.5%. Nordic's up by 4.5%. So some decent numbers, at least when it comes to the upside. Downside, I think there's an Amundi downgrade this morning. It is down on the back of that. We're down by 2%. Coca-Cola, the bottling company, down by 2.78%. And BAT. You're kind of leaning more towards chips, which means you're more leaning away from stocks like BAT. I think that probably is the narrative that we are watching there, Tom.
OK, here's what else you need to know this morning. Oil holding recent gains. It's around $83 a barrel right now as a final deal to reopen the Strait of Hormuz between Iran and Oman remains elusive, while Tehran ruled out direct talks with the US. President Trump says Washington is, quote, semi-negotiating and can wait for Iran's economic suffering to soften its stance. The yen is underperforming all of its G10 peers, putting traders on alert for the risk of further intervention by authorities. Meanwhile, the Bank of Japan has flagged the risk of inflation heating up in the summary of views from its July meeting, with one board member noting the possibility of a faster pace of rate hikes. Typhoon Dolphin made 2 landfalls in eastern China on Sunday after Beijing issued its highest storm alert. The storm has forced the evacuation of over 390,000 people in Taizhou and over 100,000 people in Shanghai. Flights throughout eastern China remain heavily disrupted today, with almost 1,200 flights cancelled at Shanghai's 2 airports. Guy.
Well, let's stay with the extreme weather theme, but focus more on what is happening here in Europe. Battling, as we know, increasingly frequent and increasingly devastating blazes, wildfires. Insurers are now turning to catastrophe bonds, cat bonds, to offload the soaring financial risk to private investors. Industry experts say it's only a matter of time before the continent adopts this strategy on a much wider scale. We've seen it in the United States, and it's proved to be very effective at funneling capital into an emerging area of focus. Tanya Roche is the head of cat bond portfolio management at 12 Capital, and joins us now. Tanya, thank you very much indeed for your time. How would you compare? Let's just kind of start comparing kind of apples with apples or apples with oranges. How does the European cat bond market compare with that over to what we see over in the United States?
It's really vastly different nowadays still. So the cat bond market is very dominated by US risks, and we do see US wildfire risk among them, but we have very few cat bonds covering European risks overall, and as of today, we don't have any European wildfire cat bonds in the market. So very different level of coverage.
Is that going to change, and how quickly can it change?
Well, the points are really in the direction of a change because the need is clearly there to have more of that European risk also transferred into the capital market. But it does take time. And the wildfire that we're seeing right now is a very good example of a peril that is not as mature as we'd like to call it, kind of in the modeling space. So it's very hard to underwrite as it currently is. And even if the market is very quick, it's certainly going to take another few years for it to be part of the cat bond market.
Tanya, good morning. Could this ultimately, longer term, could this be bullish for the cat bond market?
I would definitely say so. It's a very effective measure to share those very peak risks that are very hard for societies or governments to carry on their own. If we transfer that to the capital markets, and going to need that because of the climate change and those catastrophes becoming more frequent and more severe, this is a very good case, a fundamental case to drive the market for further growth.
And you mentioned the modelling. Are we getting closer to a point where the modelling is better at adjusting for the risks? What needs to change in terms of the modelling around some of these climate events?
Data. We need data. That's the big difference that we have between the US wildfire situation and the Europe wildfire situation. In the US, we have many years of claims data, actual events, including their insured costs, and that's really what's missing in Europe right now.
How much, in terms of what is happening in Europe right now, how much of it is property, things that need insuring? How much of it is vegetation? I'm just trying to understand, as I watch the wildfires around Europe this year, how much of what has been burned would have needed insuring and could have been covered by cat bonds, Tanya?
That's a very good question. So far, thankfully, in Europe, it's just a smaller part. So most of what we have seen is burned vegetation. It's really forest land, it's rural land, and the fires have not reached that densely populated, urbanized areas, which is really the contrast to the wildfires, for example, last year around LA, that made the difference in terms of insured values.
So can we assume, though, that at some point we are going to get to where we are in the United States, that these fires are going to increasingly affect urban areas? When you look at the modelling that's being done, when you read about what is expected to come here in Europe, do we have a window of opportunity before that starts to happen to get this market sort of up and running and generate some coverage for when that happens?
Exactly. That's really the challenge that we're facing. It's probably, unfortunately, just a matter of time until there is a fire that we cannot control, and it does cause more property damage, and then there is this window opportunity, as you said. But we've seen with these fires in Europe, and again this last year as well, that they become so much more frequent. The conditions, the weather, driven by climate change, is just so conducive that the race is really a challenge.
Yes, and the heating and the rising temperatures in Europe most pronounced, of course. Tanya, if we get to a point where there is better data, where the modelling improves, what is your sense of the appetite amongst investors to get exposure to this asset class?
I would think that the appetite is very high. Generally, capital market investors are very open and welcoming to new perils and new regions because they are diversifying for their portfolio. So it's really seen as a benefit, but really on the basis of a statistical confidence, and that, as we discussed, needs a maturing modeling landscape.
Okay, so we need the data on the modelling. The investors are largely there. So what is your sense of how this is going to evolve now, Tanya? Is this something that we're going to watch evolve over the next couple of years? Is it going to take a decade? What is the timeline?
I would assume something like maybe half a decade to do something that's of scale, because we have seen some similar timeline in the US, where the wildfire used to be a secondary peril with very low underwriting confidence. It was not really welcomed by investors, and that really has changed over a couple of years, let's say the better of a decade, and we are now really urgent in Europe, and I think we have a lot of media and regulatory attention that might speed it up a bit more. So my best guess would be something 3, 4, 5 years, hopefully, to have this as part of the market.
Okay, so maybe three to 5 years. Tanya, before we let you go more broadly across the cat bond market globally, there's been, I think I'm right in saying, record issuance. Are we seeing are yields being compressed? Are investors being rewarded for that additional risk?
Yeah, generally, more issuance that has been offered to the market, it has been very well received by an equal amount of demand for the risk. So in terms of supply and demand, we've seen a bit of a normalization from the incredible record spread levels that we have seen in 23 and 24, but we're at normal levels, long-term levels of spreads, and it's very attractive and it remains decorrelated. So the attractiveness of the asset class, I think, is there and is continuing to thrive.
Tanya, thank you very much indeed for your time. Tanya Roche, Head of Cat Bond Portfolio Management at 12 Capital. Coming up, markets mull a murky outlook still for a deal to reopen Hormuz. We're going to get the latest from the Middle East next. This is Bloomberg.
Welcome back. 44 minutes into the equity market session here in Europe, and I don't have a great deal to report in terms of things that have changed, certainly at an index level. We've got tech on one hand doing fairly well. The more staple side of the market is doing less well this morning. Pharma's actually having an okay kind of a day. In terms of the US futures picture, remember we had a very strong kind of end to the week last week. Currently, S&P E-mini futures are up by 0.2%. The Nasdaq's actually climbing a little bit. We're up by 0.4%. So that TSMC read across not only affecting Europe this morning, but also feeding through into Nasdaq futures as we start a new week stateside.
OK, let's get some detail on how some of the energy producers in the Middle East are adjusting in light of the continuing tensions, of course, in the region. Adnoc Gas considering a new export facility outside the contested Strait of Hormuz in Abu Dhabi's latest move to build infrastructure to avoid the critical waterway that has been largely shut, of course, during the Iran war. The CFO spoke to Bloomberg earlier, where he discussed the challenges and impacts being faced.
But the company, of course, has a focus on managing today challenging environments, which you've seen the numbers, has resulted in very strong net income of $600 to $65 million. But at the same time, we look forward. We look forward with that investment in that we announced today, new facilities, and also, to your question, looking at how can make the company even more resilient, whereby you would look at options of locations on the east coast of the UAE.
The reality of the situation in the Strait of Hormuz is that ships are still getting attacked or are at the risk of attacking. The latest from this weekend, including an Adnoc vessel. So when you factor all of this in, do you put in additional costs to your balance sheet that you have not previously accounted for?
So, good question, because there are, in our estimates that we give to the markets, always ranges. Example, 600 to 800 million for the third quarter of net income. For the full year, $3.5 to $4 billion. Those ranges have all to do with how many ships can cross the Strait of Hormuz. And that crossing or lack of crossing does sometimes have an impact on cost. So far, we have seen that the suppliers, vendors, people are quite flexible and are starting to adapt. You cannot deny that there is an impact, but at the same time, when we look at our investment programs, we use EPC contracts, whereby we very much manage the schedule, but an EPC contract provides us with a lot of protection for cost increases.
That was the Adnoc Gas CFO speaking to Abir Omar a little earlier on today, and she joins us now. As we watch oil holding on to recent gains, we're trying to understand where we are with the reopening or not in terms of the Strait of Hormuz. We were expecting progress. We have not had that over this weekend. Iran very much, once again, ruling out direct talks with the United States. On the other side of the world, President Donald Trump saying the White House is only, quote, semi-negotiating with Tehran. So where do things stand this Monday morning? Let's get an update on that. Abir's back. Where are we? We're getting a press conference that's taking place. The Iranians are giving us more details. What do we know?
Yeah, good morning, guys. So I'm looking at those lines that were just crossing across the Bloomberg terminal. The Foreign Ministry saying that they're demanding compensation if they want to reopen the Strait of Hormuz, really standing in line with some of the concessions that we had heard over the weekend. And that really leads me to just some of the reshuffling, Guy, that has happened in the echelons of power, if you were in Iran over the weekend. So Mohsen Rezai was appointed as the new leader of the Supreme National Security Council, replacing Mohammad Bagher Zolgadar, who is a fellow hardliner. Now, why this is important, those two hardliners, the reshuffling there, they were asking for those concessions, a return really to some of the things that we were hearing during that MOU signing in Switzerland back in June. So they're demanding a permanent end to the war, lifting the U.S. naval blockade, a withdrawal of all U.S. forces, ending all sanctions, freeing Iran's frozen assets, and paying compensations to Iran. Now, all of these concessions are going to be a really hard sell for the United States. But then when it comes to the actual deal that is being negotiated between Oman and Iran, what we've been hearing over the past week or so is it is at the final stages. We have been expecting the formalized final draft of that. What we understand it is it will be some kind of mechanism to help ships cross their way through the Strait of Hormuz. A lot has been reported about what exactly are going to be the intricacies of this mechanism. But Guy, it's just important to note that nothing is formal yet. The Foreign Ministry has been speaking over the weekend. The Foreign Minister has been speaking over the weekend about those negotiations. But it's just important to note that we need to see the formal final draft of this document to be able to determine what the impact actually is going to be on the Strait of Hormuz and inevitably on those energy prices.
Abir, what is the pressure that the US is currently putting on Iran?
Well, there is the question of what kind of pressure it is trying to put on Iran. President Trump did say that he is waiting for the economic woes in Iran to start taking their toll on the officials there, and therefore soften its stance. Now, that is, a return to what President Trump had been laying out at the beginning of this war. And two important things here, Tom. We've been reporting, of course, and multiple news agencies have been reporting on the U.S. running low on ammunition, something that President Trump and other U.S. officials had refuted multiple times. And then going back to a state of putting pressure on Iran, that's really betting on the fact that Iran will succumb to the really high inflation levels, 77% year on year, for example. But then we can't forget the fact that it takes a very cheap amount of money for Iran to produce those drones that have been attacking ships in the Strait of Hormuz. Up until the weekend, we were talking to Peter Van Driel earlier, as you heard, and we were talking about the Adnoc ship that was hit in the Strait of Hormuz, killing one person and injuring over a dozen people. So it merely takes Iran the threat, the idea of a threat on those vessels and ships for energy supplies across the Strait of Hormuz to be disrupted for a continuous period of time. And so that bet from President Trump is, according to a lot of people, a long shot. But we wait to see what we will hear further from the Iranian side. They maintain for now that Washington is not involved in those negotiations. They're merely a mechanism between themselves and Oman.
Can you just also walk me through what damage we're seeing done as a result of what the Iranian-backed Houthis are doing as well? On the other side of Saudi Arabia, we're seeing refineries being hit. Now, refineries are critical at this point. And also the damage, I'm just wondering how permanent that damage is going to be, how quickly these refineries can be brought back in terms of the capability that the Saudis have.
Yeah, that's a really good question, Guy. I mean, we were talking to Adnoc, who have had their facility in Abu Dhabi hit during the peak of this war, Habshan. Now, the CFO did tell us that it was the progress there in restoring that is going faster than scheduled. But then when you talk about Saudi Arabia particularly, which the Houthis have been targeting over the past 3 weeks or so, the latest we know is that an Aramco plant in Jizan was hit over the weekend. So that would mean that it would be twice in a month that plant was hit. Now, we don't have a confirmation from Aramco or the government that it was the Houthis that hit it, but the Houthis have claimed that they have hit it. What we know is that there is no damage reported. The fire was extinguished quite fast and there were no fatalities there. But again, the threat of the Houthis themselves attacking those facilities within Saudi Arabia or the Red Sea, where Saudi has resorted to throughout the past 5 months or so to get its shipments across, that alone is enough to disrupt those energy supplies even further. We talk about the Strait of Hormuz quite often on this show and other shows, but then Bab el-Mandab, which is close to Saudi, which is in the Red Sea, is another crucial waterway that is now under the threat of not just the Houthis, but militia that is backed by Iran and other parts of the Arab world in the Middle East. So really, the notion here is that the parameters of this war have been widened significantly, and the escalation could be dangerous if it happens again this time around, possibly even more than what we had seen at the peak of this war in April, May.
OK, Bloomberg's Abu Omar, thank you for the update out of the region. Meanwhile, let's look ahead at what else we are watching throughout the week. Tomorrow, US earnings from Supermicro Computer and CoreWeave. Wednesday, IEA oil market report and OPEC's monthly oil market report. We'll also crucially get US CPI on Wednesday. Thursday, it's UK second quarter GDP and then US producer prices, plus earnings from Applied Materials stateside. Friday, we are going to be watching US retail sales. Let's bring in Morwenna Coniam now, editor for Bloomberg Markets Today. Morwenna, is the inflation data out of the US that is the biggest data point for the markets this week? How much of an adjustment could we phase out a September hike if the inflation data comes in line with expectations or below?
Well, I think it's important to note that there is actually seeing a slight pickup in inflation from last month, although it was quite a reassuring drop. So I think it would probably have to be quite a big surprise to make a huge amount of difference. I think it is expected to be reassuring. So arguably it's probably therefore priced in already. But we have seen quite a bit of movement in rate hike bets over the last couple of sessions, particularly with that softer than expected US jobs data. So again, whether there's much more mileage for that, I think it also depends on the oil price, which has obviously been creeping up again. So there are quite a lot of factors at play, but people will be looking very closely at that CPI data to see if it paints a more reassuring picture. And so far, actually, the higher inflation that we have seen this year in the US hasn't really been impacting growth. So that will be something to obviously look carefully at in terms of any more further commentary on that too.
Talking of growth, UK GDP out on the 13th, isn't it? Expected to tick a little bit up, isn't it, on a year-on-year basis?
Yeah, so we're expecting that on Thursday, and I think we are expecting it to have actually showed a continuous expansion after last quarter. So this is the second quarter. But it will be a slightly slower pace. That's actually quite a normal pattern that we've started to see, where the first quarter averages at about 0.6 and then the second quarter a little bit less than that. That's partly because we often see a bit of a slowdown at the end of the year, a slower pace of expansion with concerns around the budget. So it was quite an interesting piece out by my colleague Tom Rees this morning, sort of pointing out that actually with the new Prime Minister as well, there's going to be a lot of anxiety around the budget in the latter half of the year. So you do sort of see this typical pattern. But we're expecting to see a bit of a boost from the World Cup, of course, for June, probably before you get into a very steamy summer.
Yes, OK. And gilt markets relatively well behaved, at least in today's session. No doubt that volatility will come back to the fore ahead of that budget. Moena Koniam, editor for Bloomberg Markets Today. Thank you. Currently, you're looking at, Guy, European markets flat across the board when it comes to the headline basis. US futures, though, a little bit more positive. You pointed this out on the back of what we're seeing with TSMC. So NASDAQ futures up by 0.4% after, obviously, a very strong session on Friday. Yeah, they ticked through. And it's the continuation of that trade versus what we saw Friday, which I think is interesting as well. It's the market does seem like it continues to drive that one forward. The CEO of State Street Global Advisors is going to join Surveillance a little bit later on. Make sure you pay attention to that interview, 1:30 p.m. London time. That's it for us. We're back tomorrow. The Pulse is next. Francine Lacroix. This is Bloomberg.